Good morning, everybody. Welcome to today's 1Mby1M Strategy Roundtable for Entrepreneurs. 1M1M, as you know, is the first global virtual accelerator in the world. We operate from Silicon Valley, but with a global footprint. And our mission is to help 1 million entrepreneurs reach $1 million and beyond in annual revenue. Of course, that doesn't mean we're going to try to fund 1 million companies. The vast majority of the emphasis is on 1 million in revenue. Of course, we do have a lot of entrepreneurs in the community who are looking to fund or are funding their companies, et cetera, through the community. And so we do cover funding in a very big way. Now, this is the 382nd free mentoring roundtable from the 1M1M program. We started actually experimenting with this format back in 2008, September, when my first book was coming out. And then the format was so well received and successful that we institutionalized it, and on top of this format, we built the 1M1M Global Virtual Accelerator. So that was launched at the end of 2010, and today we have a community of 500,000 plus people, and it's been really exciting. Even these roundtables have had over 60,000 people attend. And the event is being recorded. You have all recordings available on the 1M1M Roundtable's YouTube channel. There's a lot of great video content. You can learn a lot just by following for free the recordings of these roundtables. And on Twitter, we are at 1M1M and at Romana. If you're live tweeting the show today, please use hashtag 1M1M. And we publish a lot of interesting content through the Twitter channel. So feel free to follow that. Maybe you already do and came here through that channel. And these are the call-in numbers for engaging with the conversation. This is a roundtable. We want all of you to participate. We do have programming in the first part of the show, and then we're going to go to your comments, your feedback, questions, etc. So make a note. We'll put the slide back up later and have you participate. We're going to start today with a conversation with Bruce Cleveland, founding partner at Wildcat Venture Partners. And for those of you who may have been around in the 90s and the early 2000s, one of the most successful ventures in the history of enterprise software of the time was Siebel Systems. And Bruce was an integral part of Siebel Systems, one of the key people who built Siebel Systems to multi-billion dollars in revenue. Bruce, welcome. It's a pleasure to have you here.
Good morning. How are you doing?
I'm well, thank you. So tell us about what you're doing with Wildcat Venture Partners. Given your background, you must have brought something unique to the perspective of Wildcat Ventures. So tell us what are the specifics of this venture?
Well, Wildcat is actually a joining of two different groups, three people from a former firm and me from another firm. That one firm is winding down and the other moved to pure healthcare. And we elected a couple of years ago to build a brand new platform to do early stage software investing. And I've actually known my partners for many years. All of us, one of the unique aspects of our particular firm is we all come from an operating background. So we've helped, one of my partners built a company from scratch that was acquired by Oracle and generated about $1.2 billion for his investors. And then, of course, you know, I had the fortune of working at a number of interesting companies. I started in Silicon Valley at Oracle when it was a small company of, I think, sub-100 people, and went on from there. And I was one of the first employees of a gentleman by the name of Tom Siebel, who created Siebel Systems. That's my involvement with Tom. So we all come from building from very early stage companies. We've built companies, and we wanted to take those lessons that we learned by us being entrepreneurs to see if we could provide a set of operating principles and build a playbook to enable early stage, what we might classify as seed or Series A, even Series B companies, if we could provide a set of operating principles that would enable companies to successfully traverse something that we call the traction gap, and we could talk about that a little bit later. But basically, we're a firm of 4 people. We've raised a transitionary fund, and now we're in the middle, and we've invested that across about 23 companies. We're now in the middle of raising our second fund, again, with the same principles, early stage investing focused on software across B2B and B2C, with the intent of using these operating principles to generate a better than average success rate. We realized that across each of us, most of the companies that we've invested in are companies that in this period of time, there's roughly around an 80, maybe almost a 90% failure rate. And when we did some introspection of our own investing track record and our operating track record, we've had about a 70% success rate with at this same period of time. So we've taken those principles, codified them into a framework. We use that to help us with our companies, and we're focused in again on these early stage software companies. So that's what we do.
So we'll spend some time after this conversation on specifically the traction gap framework. Let me ask you a few more questions about the fund so we know what kinds of entrepreneurs you would be interested in within our community. What sized investments do you make, and what is the size of the fund?
So our first fund, as I said, was a transitionary fund. We raised about $60 million. We both came from very large firms. So most of the limited partners that we had prior to forming Wildcat, many of them could not be investors in Wildcat because we wanted to create a smaller fund. So the fund size, we will never raise a fund bigger than $200 to $250 million. The data shows that it's very, very hard to generate venture returns off of larger funds. So that's one of our policies. We look to invest roughly around, we'll do seed funds. We'll invest in seed rounds, 100K, 250K, up to maybe 1 million. We will, but a normal investment, a full-size investment, will be somewhere around 6 to 8 million, and initially maybe 4 to 5. And the issue is on some of the ones that we're doing, maybe that at a little later stage we'll invest more. But you can expect anywhere from around 4 to 6 as being the initial investment. All in, if you added reserves, a full investment over the course of the history of a company might be 10, 11 million.
So our community's work, as you can imagine, is with the very early stages. So when you say you're willing to do seed, can you elaborate? Because what's happened in the seed ecosystem, I'm sure you're following this, is that there are 500 to 600 micro VCs that have come into the business in the last 5 years or so, maybe a little more, and that seed ecosystem has fragmented into pre-seed, seed, post-seed, pre-Series A, small Series A, and then the $4, $5, $6 million, traditional Series A. So where in that continuum do you like to peg yourself when you say you want to invest in seed?
Well, I think it's more around not the size of the seed, but the rationale for the seed. So there's a lot of companies. We like to get to know companies and the entrepreneurs really well. And we have a pretty good network ourselves, but of course, as you said, there's thousands of companies starting all the time. So we obviously can't know everyone. If there's interesting areas that we'd like to get more familiar with the team, we think that it's an interesting team or it's an interesting sector, then that's the time that we'll make a seed investment. And roughly around 5, maybe up to around 6% of any given fund that we do will be seed investments. But the purpose of those seeds is to identify a few that will be, that will become full follow-on. And one of the problems, of course, for these micro funds or these micro VC investments is that it could be a one and done. In fact, many are one and done. So that means that the entrepreneur is left with having to go figure out, well, who else can I get to invest in the company? And, you know, that could take a while. So I think one of the benefits of having at least a seed philosophy and seed strategy is that we can participate in those early stages, but then also we can tell our entrepreneurs, look, depending upon how the business goes and how things work, we can also be follow-on investors.
And when you choose to invest in a seed company, how much validation are you looking for in that business? You're not doing concept financing, I imagine. What is it that you gauge for? What metrics? We're seeing all kinds of metrics from different VC firms that they're looking for before putting in Series A.
I call those bankers. They're not actually VCs. I mean, I'm sure they'll disagree with my comment, but no, we actually do. We started ideation. I've created two companies at Wildcat. My idea, I was the entrepreneur. I started them. I built the business. I recruited the personnel to then staff the company from CEO on down. So we start there. I mean, and I think we've lost, and I don't know why, but one reason is that there was this idea that you could bring in people, you know, a traditional VC route was go to get an MBA from an Ivy League college, go to work at Goldman, become a tech banker, and then move in, become a principal, and then move your way up. For the most part, that route into venture has failed. Many of those people never panned out. What seems to be happening, which I think is actually a good thing, is people coming from industry coming back in to do these investments who can add in the operating characteristics, you know, the operating principles into these companies. But if you want to, I think, if you want to really do venture investing, the venture part is what I would determine or call PowerPoint investing, where there are not a lot of metrics. There are basically, we believe that there is a market. The market is described by X, Y, and Z parameters, that the opportunity is to build a product or service to serve that market. There's some kind of evidence, some kind of market research that's gone on to provide some evidence of that particular opportunity. And then it's, okay, what kind of a team do we need? And we use this traction gap framework, by the way, to help do the complete assessment, both in terms of the investment, the market, and then the team. And then a big bunch of diagnostics that we'll talk about. But the main thing that you're talking about is, hey, how do you find these metrics? Well, the metrics I have are basically, have we done market due diligence? Have we gone out and actually talked to 50 companies? Have we done what Steve Blank talks about? Get outside the four walls, right? And actually talk to some people to verify that there might be some, you know, some veracity in the market opportunity.
Our customer validation methodology is completely about customer immersion and getting as much feedback even before you write a line of code. So we try to steer our entrepreneurs in that direction. And what about geography? Are you investing only in Silicon Valley or across the board?
Well, our partners come from different parts of the country. So that's pretty, that makes it kind of interesting. So Brian Stolley comes from Texas. He actually sits on the board of University of Texas. So he kind of represents our Southwestern investing. Catherine Barr is our consumer investor, and she comes from Canada. So we have a number of Canadian investments. And then Bill and I, Bill Erickson and I, cover, we have a number of San Francisco-based investments, the SF Bay Area, but also we cover the Pacific Northwest. Bill spent a lot of time in Seattle, and I have an investment in Oregon and Seattle, so we kind of cover the Pacific Northwest. So we don't have coverage in the Midwest, et cetera, but you know, for the most part, we cover from the East Coast all the way here. And then we actually have in Wildcat, we have an investment in a company in London, which is a pretty cool investment. But so we're not just limited to the geographical U.S. But for the most part, we right, that's the range. And
a couple of trend questions before we go to the traction gap framework.
Yeah.
You said you've invested in 22, 23 companies already. What are those companies? Some highlights and some analysis of why you've chosen those companies.
Yeah, so first we sat down and we did some portfolio construction. I think it's super important for venture firms. One is that there's a lot of concern by limited partners when they make investments in venture firms about time to liquidity. So you need to be conscientious of that. And so when we did our portfolio construction, we do some later stage investing. And the reason we do that is to generate some earlier returns so that it pays the management fees, it gets some liquidity early, and it fights something called a J-curve, which is basically going into a negative return. So there's a reason for why you want to construct a portfolio that has some later stage stuff. The preponderance of our investing is in this traction gap period that we'll talk about, and then some in this very early stage around seed. So that gives us the ability to, the way that we look at companies is to look from stage and to construct a portfolio along those terms. And then what we invest in is so this would be the second vector. What we invest in are systems of intelligence that are being created both for consumer and for business that allow companies to prospect, refine, and monetize digital oil. And digital oil is just nothing more than data. And so the name Wildcat is built off of Wildcatter, and in those days, Wildcatters used data to determine where to drill. And so we use data to determine where we want to invest, but we also use data as a future currency that companies can monetize through different business models. So one vector is systems of intelligence designed to allow companies to prospect, refine, and monetize digital oil, and that can be in a variety of markets: fintech, edtech, martech, digital health, workplace innovation, and then all of those use technologies like blockchain, AI/ML, IoT, et cetera. So those are the underlying computer science are those technologies, and then the markets that we invest in are in markets where we are subject matter experts, and that allows us to do early stage investing where we have domain expertise and we can actually be, in many cases, a member of the operating team to help them understand the market better and maybe sell into companies. So that's the what we invest in, and then the when we invest as well.
And largely enterprise software.
Yeah, we do consumer. We have a number of consumer investments, and Catherine does most of those investing. I worked for a number of years at Apple, and what I realized at Apple is that consumers are fickle. So it's easier to, for me anyway, to identify big white spaces in the enterprise and to figure out a way to solve for those white spaces.
And in the last 12 months, what key trends have you seen in your deal flow?
Well, let's see. There's been quite a bit of robotics deals that are materializing, which is you know, and we're a little cautious on that because it's all of these. It kind of reminds me of med devices, right? There's a physical component. There's a bunch of different things that have to happen. We don't have to go through some regulatory issues, but there's just a number of issues that you have to be concerned with around hardware that requires a lot of capital. And so while we're very interested in those things, I think that we're also very cautious about it. One of our associates is a ME out of Carnegie Mellon, and he's doing a lot of our robotics research. The other thing I think that's coming that we're seeing a lot of course, is digital health. And there's a variety of things. We're not very bullish on wellness, but other things that change the model of healthcare. And those, these can be challenging because those are very difficult markets, well, at least in the healthcare they're very difficult markets to sell into. So fortunately, Bill Erickson, one of our partners, has a long history of being involved in the healthcare market, and we've got some very interesting investments there. So those are kind of the two things that we see in terms of what to invest in.
And last question on trends, and then we'll go to the traction gap framework. What do you make of unicorn mania, and how do you parse it? How do you strategize, given that is a factor in the market right now?
Yeah, well, so a couple of things. One is that one of the reasons why we like to do early stage investing is that once there's a bolus of capital that's been locked into a lot of what we would call the established firms, the ones that kind of sit up and down on Sand Hill, and they have a lot of capital to put to work. So once something is working, once it's been identified to be working, and I'll explain through this traction gap framework when that is, once things are working, then what happens is you have a bunch of firms that rush in to put money in. And once they're in, what they want to do is to try to put more dollars to work in that particular deal. Even if it's not going to end up being a 10 times multiple, et cetera, a 2 or 3 times multiple can still be quite effective to generate substantial returns if you're putting 50 million or 100 million. So what's happened is that a lot of these companies are offering, and you can see this in late stage, like TPG has a growth fund and others, to be able to basically lengthen out the time from when a company needs to actually become a public company. So there's a lot of issues associated with that, and I think a lot of perils that you need to be aware of if you're investing in those things, or if you're an employee. And this is something that I think employees of these companies need to be concerned with, because what doesn't become apparent is what the terms of those dollars are. Those dollars can come with what might be a transference of wealth from the employees into the investors. So, for example, there might be a participating preferred term put on the dollars, which effectively says, hey, we're going to take off the top of any IPO. We're going to take, or if it's an M&A event, we're going to take 2-3 times our dollars first, and then we're going to participate with everybody else in the dilution of the IPO, and that can take a lot of dollars off the table. There could also be other restrictions, like when can it go public, et cetera. So you don't know those things; they're not exposed to the populace of the employees, and you think that you're going to have this great IPO event or M&A event, and what you realize is that actually your stock is worth substantially less than what you thought it was going to be. So that's one issue around this sort of unicorn mania, where you've got a lot of companies trying to propagate these companies to stay private before going public. So that's one issue. The other part is just valuations. I mean, some of this stuff is pretty insane. And any hiccups in the business model, any hiccups in, we've seen a couple of companies demonstrate some maybe ill behavior by management. Those kinds of things can cause tremendous issues within these companies. So I think that while the business may be working in theory, there can be other issues that are associated with it. We have 3, 4, 5 companies that you would call unicorns from our prior investing that are currently private, and that's great, and they're doing well. But we invested in them when they were, either ideas or very early stage, and we're not counting on this unicorn status to make them successful. It's business model, controlling revenue, figuring out your business. Those are the important things to focus on.
So what is your strategy when you have a company like that is, has attained unicorn status and is being showered with capital from the later stage funds and the growth funds? Do you sell out at that point?
You can. A lot of times, though, there's restrictions. The company has to approve it. Generally, you don't have controlling interest in that company. And so there's a bunch of other investors around the table that may have a say in it. So there are secondaries that you can sell, secondary markets that you can sell out into, and that is a strategy, and that is with the better investments that you do, there is a market for those, and that is a way to liquidity. So I think that not a lot of this is really disclosed that often. But you get contacted when people know that you've got an investment in a hot company. There are people who are willing to invest at this moment because they're not looking for a 10 or 20 times return. They're looking for a 2 or 3 times return. So there's different predators that roam in the financial market, and they tend to hunt you down.
Yeah, okay, cool. Well, we are going to spend some time with Bruce going over the traction gap framework next. So Bruce, over to you. Your slides are on, and I will move your slides. You can just tell me when you want me to advance your slides.
Okay, so let me just I'll tee this up. One of the problems that, this is just a fact, one of the problems is that there's a preponderance of failure in early stage companies. And when we took a look at our own success rates, we realized that we are having far better than average success rates with our early stage companies. And while we didn't have common language when we first came together as a team, what we realized is we did have a set of common shared experiences from being former operating execs. And we weren't just operating execs at large companies. We started with those companies when they were first created, Siebel Systems, Agile, Marketo, et cetera. So the benefit that we brought together was we realized, what if we could create a process and codify it in a set of principles that this might be useful. One, as a venture firm, but the second piece is that it's useful in terms of deal flow, right, for us, because we need to create awareness. We're a brand new firm. Many people have never heard of Wildcat Ventures. They've heard of Sequoia. They've heard of Benchmark, but we're brand new. So we needed to create something that was differentiating. So I brought with me a set of ideas that I had been working on for a few years, and we sat down together and we basically fleshed this out. And one of the advantages we have as a firm is that Jeffrey Moore, the author of Crossing the Chasm and Inside the Tornado, is one of my partners. So we were able to work together, and the traction gap, as I'm going to explain in a second, is really a precursor to crossing the chasm. You can't cross the chasm until you traverse the gap. And so what I'm going to take you through now is, what is this thing, how do you use it, and how does it help us as investors and you as an entrepreneur in how you look at your company. So if we go to the next slide. Yeah, so the facts are that, and we could debate the numbers because they are kind of all over the map, but when we took a look at a lot of different data, basically what we found is that from seed, there's roughly a 10, maybe 15% success rate. If you can make it to Series A, roughly about a third of those go on. And then if you can make it through a Series B, roughly half of those make it. But when we looked at our own investing and as a team, we realized that we have about a 70% plus survival rate for all the investments we've made as professional investors from our prior firms. And we wanted to know, well, why is that? why are we able to do something where there's a lot of very capable, smart people, you know, in the venture world? I mean, they all went to great schools, they all have capital, many have operating experience, et cetera. But why is it that we were being successful? And we realized that we had some interesting experience that we could apply to this. So if we go to the next slide, I'll cover that. So it really boils down to this. Every company needs to go through 3 phases. The first phase is what we would call the go-to-product phase. That's what Steve Blank, Eric Ries, Lean Launchpad, Lean Startup, get outside the 4 walls, get the product market fit. There's a lot of help and assistance in that first phase. You can go to Y Combinator, you could go to a variety of entrepreneurial courses. There's a lot of angels that will help you. And that particular area is well-trod ground. If we skip to kind of the 3rd phase, which is the go-to-scale phase, that's the crossing the chasm period. That's where the product's working. You've got a whole set of different problems. You're worried about scaling your company. And so we call that the go-to-scale phase. But in between those 2 bookends is this go-to-market period. And when we examined this particular period, what we realized is that there really is no roadmap for entrepreneurs to understand how to go from having a product to getting to this theoretical point in time called traction, where the market is accepting the product and you're able to begin to think about scaling issues. And one of the things we realized is that if you go as an entrepreneur with strong product capabilities, many have never actually added other elements, and we'll talk about what those elements are, because this is a team sport. So there's really nothing that's been unpacked. There's been no playbook for this go-to-market period. And so we decided to write the playbook for how to make it from product to traction. Okay, so next slide.
So before we go to your next slide, I just want to make the point that in 1Mby1M, we extensively covered that phase. We have full, curriculum modules on that phase. One of our most popular curriculum modules is what we call Sales 2.0, which specifically focus on, okay, you have 3 or 4 or 10 customers. How do you go from 10 customers to 500 customers?
That's great. So what we decided to do was to codify this into a set of value inflection points. And one of the things that entrepreneurs don't really understand, or at least initially, is that they not only have to build a good or service that they have to sell into the market, they have to also sell a product for investors. And the most treacherous part of a startup's time, if they're going to seek outside investment, is to be able to articulate the amount of capital they need, the amount of time they need in order to traverse this really difficult point in time, in order to get future financing. And the engineering part of this is to raise enough capital to reach the next value inflection point and to not run out of capital before reaching that value inflection point, or you will have a very challenging time of raising additional capital and, in fact, could even go out of business. So we've created, using and adopting Steve and Eric's vernacular of MVP, we've built a number of other value inflection points to create a more fine-grained approach and a model to how to do this. And not only do these value inflection points have names and definitions, but we have the amount of time, the amount of capital, the amount of revenue, the team. We've interviewed dozens and dozens and dozens of companies that have made it across this period, and we have deconstructed their plays. What play did you run when you first had MVP when you were at Marketo? What were you thinking about when you were trying to get to minimum viable repeatability when you were at Salesforce, Mark? So we've interviewed the best-in-class CEOs and founders across Silicon Valley and other areas, and we put that into what will become a book that I'm writing on the traction gap. So, but right now it's in the form of a guide. In fact, you could download this. We've created a separate institution called the Traction Gap Institute, where you can go learn how to do this. And the reason is very selfish. because this is a way of creating differentiation for us as a venture firm, because nobody else has created an early stage playbook like this, and nobody has plays that have worked and know how to run that have been exposed and made available to companies. So it's one thing to read it in a book and to hear what somebody else did. It's a whole entirely other thing to actually have the recipe laid out for you. So these are value inflection points that we've created: minimum viable category, initial product release, minimum viable product, MVR and MVT, minimum viable repeatability, and MVT. These are all well-defined, and again, this is a full, we've taught this at Stanford and Berkeley, University of Chicago, and a variety of other places. But the framework itself is a way for you to think as an entrepreneur about how you're going to get from wherever you currently are to wherever you need to be for your next financing. And the purpose of this is to effectively also, for us as investors, is to create milestones and objectives for you to reach it. So we can go to the next slide.
So a few questions before you go to the next slide on what you talked about here: minimum viable category, minimum viable product, minimum viable repeatability, and minimum viable traction. So how and where in this continuum do you address the question of velocity? Because in venture, the difference between a company that is venture fundable versus one that is not venture fundable is velocity. Right? A lot of companies can get to 5 million, 10 million, but not at venture pace. So where and how, in your methodology, do you peg that or assess that?
So wait for a few more slides and I'll show you, because it's very, okay. We've unpacked dozens and dozens of S1s. For at least B2B SaaS, we're doing it for B2C to show you, because as you're right, from ideation to IPR, you get 12 to 18 months if you're a B2B SaaS company. From IPR to MVP, about another half a year. From MVP to MVR, about a year and a half, and from MVR to MVT, another year. MVR is 2 million of ARR, MVT is 6 million of ARR. And all of this matters. Again, it goes into very deep detail, but that's to your point. You don't just it's not just a matter of reaching these points. You have to do it within a certain amount of time. Why? Because 50 other B2B SaaS companies that are public did it in that time or less. So you need to be able to be on that same revenue curve. In addition, once you go beyond minimum viable traction, which is about 6 million of ARR or 500K of MRR, you are on a different scale. And that scale, I think Battery calls it T2D3. I call it the Fibonacci series of SaaS. So basically, you've got to go from, at MVP, you have to go from 1 million 1 year later to 3 million to 10 million to 25 million to 50 million. If you're not on that revenue curve, you are off model. And the ability for you to be able to raise capital becomes significantly more difficult. So these are, you brought up a really good point, which is the other piece to all of this is not just these value inflection points, it's hitting them in the time period that's allotted. And that's one of the reasons why a lot of companies want to raise capital. There's other reasons for this. You don't just get 15 years to kind of build a lifestyle company. You've got to build a company that traverses this gap in these time periods and goes on in the go-to-scale phase. So great question. So there are 4 key architectures that are present at the moment that you decide to create a company. And we've codified it into product, architecture, revenue, systems, and team. And each one of these things, each one of these architectural pillars needs to be addressed in order to be able to make it to the next value inflection point. And so what we've done in our interviews is to identify what was the team makeup when you were at MVP? What were the systems that you were using? What were you thinking about in terms of a revenue model? Is it direct sales? Is it inside sales? Is it e-commerce, et cetera? And then product. Product is probably the best covered of most of our teams, because in my 30-some-odd years of doing this, and every product I've ever tried to build and every company that I've invested in, so I invested in Marketo when it was an idea, Workday, et cetera, these are all great ideas. every one of those teams were great product teams, and were able to build product and bring them to market. I haven't tried time machines, but it may take a little longer to build them, but for the most part, most of these teams are well versed in that. But most of these teams coming out of either school or coming out of a great company like Salesforce or Facebook, et cetera, all of the revenue architecture systems and team were all done for them, and typically well before they ever joined those companies. So this is stuff that needs to be learned, how to build a revenue architecture team and systems. And so we focus a lot on these 4 pillars at every value inflection point in order to be prepared to move to the next value inflection point. We can go to the next slide. Okay, so one of the big ideas, is that, and here's a good example. I'll get an early stage entrepreneur comes in, let's just pretend it's 30 slides. Of those 30 slides, the first 28 are all about the product. They could tell me, okay, we're using AngularJS, we're a front-end React shop, we're going to use microservices on the back. I mean, it's in very explicit detail. Slide 30 is the ask slide, right? That's the hey, we need 500K, or we need 5 million, or whatever it is, whatever they're raising for the following purposes. What I call the miracle occurs slide is slide 29, and that's the revenue slide. It's whether it's MAUs, DAUs, revenue, it doesn't matter. There's some sort of big giant hockey stick, and I look at it and I said, okay, well, let's back up, Scooter. Why aren't there 28 slides on revenue architecture? You have to at least have an idea about the conversion rates, the cost of customer acquisition, the lifetime value of that customer, et cetera. Yet none of that, at the very beginning, none of that is even theorized. So how can you possibly know how much capital you're going to need to raise? How do you know what it is that you're aiming for unless you've decided what those targets are? So this is the way that I like to joke about it, but the truth is everything really revolves around this revenue engineering, and I like to be very explicit about it. So the next slide.
And to be fair, this is what I think a lot of the firms that are looking for specific metrics, they are trying to engineer, against what metrics they are willing to invest at various stages in the venture. We kind of kidded earlier in the discussion that these are bankers and not VCs. Yeah. But they are trying to do this, and I think the work that you are doing in codifying it actually will help the broader community to understand that and engineer it better.
Yeah, I don't mean to. I'm not trying to diss on my brethren VC. I'm just trying to be, to make it somewhat humorous. So one objective that we have with all this, besides helping companies be successful, is we would like to eliminate this conversation around Series A. Are you a Series B company? Are you a seed company? Because these are terrible proxies for company maturity. They tell you nothing. I have a database company. We're on our 4th round of financing, and we're just at MVP. Is that a terrible company? No, it's a database company. It takes tens of millions of dollars to build that product. And these are some of the companies that we invested in. I invested in Marketo when it was just an idea, and that was a Series A. Okay, well, that's great. Was that a seed? No, it was called a Series A. And these are some others. So this just shows you how what a terrible proxy talking about your company in terms of Series A, B, C, or whatever. These terms that we proposed, IPR, MVP, MVC, all these terms are terms that actually define where you really are in terms of company maturity. And I think we would like to change the conversation in the entire entrepreneurial world between entrepreneurs, venture capitalists, or investors of any type, and limited partners. We think this is far more representative and a far better calibration for where you stand as a company. So we can go to the next slide.
And this is the question I asked you at the very beginning, is what do you mean by, when you're trying to invest in seed, what do you mean by seed? What are you looking for? And you've just laid out a great vocabulary to be able to peg where venture funds actually start investing. It's perfect.
So, yeah, so we hope it's helpful. So I'm going to give briefly, because I know we're running out of time here, I want to give, you asked, well, how do you use it, the velocity, et cetera. So this is where this becomes really meaningful and helpful, because we rewrite all of our portfolio companies' operating plans using those calibration points. So if we go to the next slide, we'll show you how you do that. So this deals with velocity. The first thing we talk about with our companies, and this is for SaaS B2B business models, B2C coming, we say, look, when you get to MVP, you get 12, 18 months to get to go through the go-to-product phase. A database company, it's going to be longer. If you are a mobile app, probably a lot less. But for the most part, this is relatively accurate based upon all the data that we've examined. The cool thing that you get as an entrepreneur is to declare when you really have an MVP, because at that moment, when you decide that you have MVP, and it doesn't have to be revenue, it just has to be, when do you think that your product is really commercialized? Once you say go, you get a year and a half to get to MVR, minimum viable repeatability. What is that? I've built multiple releases. I've hired multiple people. I'm beginning to get a sense of, after I've sold it multiple times, of what the cadence of the sales cycle is, the sales velocity. We're beginning to move from a PowerPoint company to a spreadsheet company, where I can begin, if I were to go to somebody on Sandhill, I could actually show them some metrics. And so you get about a year and a half to reach this magical point called MVR, and that's about $2 million of annual recurring revenue. From MVR, you get about a year to get it to MVT, minimum viable traction, and as I said earlier, that's about $6 million of annual recurring revenue, or about $500K of MRR. Why do we call it MVT? Because that's the point in time when a lot of mid-stage firms or firms looking for more metrics around your company are willing to invest. That's when, if you do this in this amount of time, this is when groups like Benchmark and Sequoia and Excel and others get super excited. They'll invest back at ideation if you're Josh James and you did Omniture and now you're doing Domo. They'll invest with great, entrepreneurs all the way down at ideation. I don't want to mislead anybody. But the preponderance of investment, the preponderance of support really comes usually somewhere between MVR and MVT. And that's where people fight to get into deals, because the business model is working, the product is working, and you can identify the market. So your job as an entrepreneur is to manage this process across 3 years. And this is the time, and this is kind of how it breaks out. So we can go to the next slide. And
question on this, what do you assess is the ideal denomination of financing for these two phases, the MVP to MVR and the MVR to MVT?
Great question. Next slide.
All right.
Okay. So, well, actually, it'll be the one after. So I give you the breakdown. I just told you what these numbers are, so we can actually go to the next slide, which will address your issues. Okay. So why do we care about this? All right. So if we just build it and customers came, we wouldn't need to worry about a lot of things. But that's not what happens, all right? What we need to figure out is, let's say we want to go from MVP to MVR, minimum viable repeatability. And we know that on average, we think that we can get about $60K in an annual contract value for our product. So that would be a $60K ACV, $60K converted into annual recurring revenue. Okay, so just simple math would say that, well, if we got to get, it's $60K and we got to get to $2 million of ARR, it's about 33 customers. Let's pretend that the cost of acquisition, that you are awesome at this period of time in acquiring a customer. So if you're awesome, then you would have a CAC ratio of 1, which means for every dollar spent in sales and marketing, you're booking $1 of revenue. I'm going to tell you, you are not. Most companies are not awesome at this time in this time frame. A group, most require a lot more effort than that. There's very few products that can kind of become viral in this stage, especially for B2B SaaS. So let's just use the standard kind of industry vernacular here. If you were really, really good later, you'll do, it's about a 0.5 to 0.75 CAC ratio. Most companies at this stage, 3 to 5 times. But we're going to pretend, because I think this helps polarize the conversation, that that it takes $1 to acquire $1 of bookings. So by definition, then, you're going to need about $2 million in capital to reach $2 million of ARR just for sales and marketing. Unfortunately, we don't just have sales and marketing. We have R&D, we got GA, we got a lot of other stuff we got to pay for, and that's roughly another 50%. So you're going to need, at a minimum, to get from MVP to MDR about $4 million in capital, and that's if you're really good. I would argue that's why you see what we would classically call a Series A of somewhere between 4 and 6 million. And that's why. I don't think anybody's unpacked it this way, but that's basically what's happening. So as companies look at this, this is how you can look at it, evaluate it. And what I would argue is you are not going to be awesome at acquiring companies, which is why you're going to try to raise a little more capital, maybe about 6 million instead of 4 million to get to your 2 million of annual recurring revenue. If you fail to make it, if you fail to make MDR on this amount of capital, that is the problem. That is where you fall into this traction gap problem. And that's where, when you go to do your presentation to somebody on Sandhill, for instance, what they'll say is, wow, really like the idea, like the team, why don't we stay in touch? Let's check back in 6 months to see how you're doing. You walk out of the meeting as the entrepreneur going, what the hell happened? I mean, we have product, we have stuff, and what they're really assessing is go, you really haven't demonstrated an ability to be on this traction gap revenue acquisition model, and you haven't demonstrated an ability to acquire a customer in a cost-effective way. So that's what they're really telling you. They just don't tell you in actual metrics that you can use in order to avoid future rock-fetching exercises for the venture capitalists. So that's how we use this. There's a whole bunch of other stuff on this, but I hope that gives everybody an idea about how to apply this traction gap framework. We can go to the next slide.
So, Bruce, just one comment here. A lot of companies cannot raise $6 million on an MVP, and that's part of the issue with where we are in the venture capital business today. VCs are not willing to do a Series A on an MVP right now.
Right, so they don't need to. What you do is you raise to get to an IPR. And there are different animals that exist at different value inflection points. And that's the other thing that entrepreneurs should realize is, as you said, there's all these different groups. There's pre-seed, pre-revenue, what you need to realize is that it is a continuum of different types of investors who have chosen to sit at different points on this traction gap model. And the reason they do is because they feel they can get signal earlier for a variety of reasons in areas, make an investment earlier because their job then is to go get the next investor downstream to invest in the company. And so it's important when you're an entrepreneur not to waste your time with groups that want all these metrics and try to raise 4 million or 5 million. What you want to do is raise enough to get to, if you're at ideation, you want to raise enough to get to initial product release. If you're an initial product release, you want to raise enough to get to MVP. And so that's that's why I say this is not just an operating strategy, it's a financing strategy. And once you realize that, and once you look at these numbers, you begin to now finally have targets and strategies in order to get from one to the other. This right here, this slide is just what I explained earlier, this Fibonacci series of SaaS. The traction gap period is really just from this early, from around IPR MVP to MVT. But it goes on beyond that, and as a company, you're going to have to, once you traverse the gap, you're going to have to then build your company to meet these next revenue targets. And there's a whole different set of issues that you need to worry about at that point. But that's the go to scale phase, and this is the game that you're playing in. This is the field that you've chosen to play your sport on, and you just need to know what these numbers are so you can build your company accordingly. We can go to the next slide. This just shows you kind of, well, how do we come up with these numbers? How do they work? I came up with my own math and my own science. Fortunately, it was the same. I used the same data as Battery did for their T2, D3, triple twice, double three times path. Marketo and Workday were two companies that I invested in. They followed these models. And again, if you're off model here, then you're going to have a different valuation. So the strategy is, if you can make your model, if you can make your business fit these revenue growth curves, then the likelihood of you being able to raise is substantially higher, and the amount you can raise is substantially higher, and the dilution is substantially less. That's the game that you're playing here. So this is just a way to expose what other great B2B SaaS companies have done, so you can see how do you stack up, and what do how do you have to play against these companies. Okay, next slide. So in order to make this accessible to everybody, we created a separate entity called the Traction Gap Institute. Anybody can join. There's no cost. Lots of data, lots of articles, lots of content. We hold quarterly events with the Traction Gap here in the Bay Area. Our next one is, I think, in March. IDEO is sponsoring it. It's all around product architecture and product design. We've done team architecture. John Baird, who's the founding partner of Velocity, one of our sponsors. He was Steve Jobs' CEO coach. He's Tim Cook's current coach. Phil Knight at Nike. John Chambers, you probably heard of these people. We're fortunate to have John and his team help us with team architecture. And one thing that we do, it's not available to everybody, just our portfolio companies, which is we have a traction gap assessment and diagnostic process where you go in, we do a complete diagnostic, you as the team fill it out. It then generates metrics around this entire traction gap framework. That then rolls into a traction gap session with Jeffrey Moore, and it comes out with a traction gap operating plan to address deficiencies in product, revenue, team, and systems architecture. And then we have a bunch of partners who work with us in those different areas that are available to our portfolio companies to address each of these issues. And we've partnered with the best in class, we think. There's certainly, it's not the sum of all great groups to work with, but we have great groups like CEO Quest, which helps us with revenue architecture, the Athena Alliance with Coco Brown, where we bring in women board members and board executives, which is a very, we think, a very powerful partnership with that group. And a bunch of others. So the Traction Gap Institute is a great place to get involved in this if you want to learn more about how to use it, how to apply it. And then, as I said, if I can get around to finishing this thing, we'll produce a book or a guide on how to do all of this, where we also expose all the plays that your favorite CEOs and founders that we've all heard of at great companies, where we've interviewed them and documented what they did when they were at your stage. It's pretty cool, and a lot of fun doing it, and I think you'd enjoy being a member of this thing. It's very informative. So that's, I think that's the end of what I had put together for this morning, but I hope that's a good introductory to what we're trying to do and how you might be able to use this framework yourself in terms of figuring out what to do with your company.
Yeah, and I think, I'll compliment you on really doing some very deep thinking on, the business of venture capital and how businesses are built, how companies are built, that you are able to codify and, you know, get it out there for people to follow, because there's been kind of, you know, much more of a black art, and the effort that we have put in 1 million by 1 million is to really put methodology behind that, you know, black art, basically, that has been Silicon Valley's tribal knowledge, and we followed a lot of similar procedures as you. We have interviewed 800 plus CEOs who have built companies in various formats, whether it's venture-style companies, unicorns. You know, we've had probably 50, 60 unicorn companies in the case studies. We've had 300 plus bootstrap success stories where there is no financing whatsoever, but people have built very substantial companies. There are lots of bootstrap first, raise money later case studies. So we have done a certain amount of codification, and I love the fact that you are putting in all your experience into this book that I hope you're going to finish, and we will have a chance to access the knowledge. Thank you, Bruce. It's been a wonderful session. Thanks for participating.
Great. Thank you so much. All right, good day.
Okay, folks, we have, today, as you can see, we have violated a little bit of our regular format and had Bruce on for much longer. Normally we do half an hour of the guest, and then we do entrepreneur pitches. So we will only do one entrepreneur pitch today. Just to set expectations, folks, this is a safe working session. We will look at your ventures and we will strategize together and try to help you put one foot before the other and remove your roadblocks. There is absolutely no other agenda here besides helping you move forward. Now, if you disagree with my feedback, that's fine. It's your venture. You will make the decisions. My job is to give you some feedback so that you can navigate your way through your roadblocks. One thing you have to remember is not all businesses can raise money, not all businesses should raise money, and raising money does not guarantee success. So all the things that we discussed earlier today with Bruce, there is a whole continuum of, you know, stages and phases that you're going to have to cross. And what pace and what velocity do you cross those determines whether you have the ingredients of a venture fundable startup in your business or not. And all that has to be assessed, all that has to be strategized against, etc. So there's a tremendous learning curve for a first-time entrepreneur in particular, and you're going to have to learn all those things. And here we're just starting to get you going on that process. So we're going to speak with Steve Lorusso. Steve, please unmute your line and tell us what is Lorusso Machine.
Okay. Can you hear me okay?
Yes, we can hear you fine. Yeah.
Okay, great. Well, I've invented a machine. If you go to the next slide, and that's a table of contents, then the next slide, invented a machine and then a company, and our main goal of Lorusso Energy Systems is to produce a machine that generates electricity while at the same time cleaning the atmosphere of harmful greenhouse gases. Okay, next slide. It's going to establish a new category in both the environmental and energy fields called a NEAM. Not an engine or a motor. It's a revolutionary energy-producing machine that manipulates a force of nature to generate power. Next slide. A NEAM is a negative emission energy machine. Again, a machine that cleans the air as it generates energy at high efficiency. Energy-producing machine with zero drawbacks. Most energy-producing machines have some type of drawback, whether it's heat, inefficiency, pollution. This new technology has none of that. Next slide, please. So, you know, everything, how energy is produced is always a battle for efficiency. So the internal combustion engine was introduced 130 years ago. It was very, very inefficient. And the biggest industrial diesel engines are only maximum 40% efficiency. Gas and turbine-fired electric production is about 40%. Nuclear power is 42%. Wind is very inefficient, 12 to 35% when the wind is blowing. It's just not very efficient. Solar, the efficiency is increasing lately because of new technology, but still, my machine has been rated at 49.9 plus in efficiency ratings. Next slide, please. So our goal as a company is to secure international property rights, build several commercial-grade prototypes for specific industries. We plan to work on streamlining manufacturing for future development, and then establish sales channels and license to various industries. This new technology lends itself to many different industries. We want to secure funding and introduce the world this future of new energy creation. Next slide, please. So how it works. The machine works by using low PSI, which is pounds per square inch, and high CFM, cubic feet per minute, from any air source, from an air conditioner, from air pressure in a building. All different types of air sources could be used to generate energy that are right now just wasting energy. It can be used before or after any apparatus that uses forced air. So input or spent exhaust gases will make additional horsepower used to increase the efficiency of whatever machine is putting out that waste energy. Next slide. So it can be used in homes, local grids, all forms of ground and marine transportation, large manufacturing plants, hospitals, corporate campuses, and large office buildings, all at the same time cleaning the air as the machine works. So next slide. It's a positive impact. The machine will have a positive impact because it has zero emissions while cleaning the air of toxins. No heat production, can be combined with existing appliances. The efficiency will increase in time. If it starts at 49% efficiency, they were able to multiply the efficiency of a combustion engine times 10. It would be impossible to do that with my machine because, you know, it's just, you can't have perpetual motion, but the future is very promising. It's low technology, it's a low cost, it's good for third world countries. It can be made with existing technology. We're not reinventing the wheel here. It increases the efficiency of existing renewables. It'll work with solar or wind, and it'll increase the production of gas and oil electric production. Next slide. It's going to establish a new industry. It should be a cleaner environment with worldwide usage. There's many countries that need it more than our country does. It's an American innovation. It'll create additional jobs. We'll have less reliance and we'll use less fossil fuel because of the efficiency of this machine. And then, because it cleans the air as it operates, fossil fuels are no longer the monster in the closet. So everybody hates fossil fuel, everybody likes wind and solar. But if fossil fuel isn't a polluter anymore, then now they're not the enemy. Next slide. And if it sounds too good, I have a working prototype in my garage. It's patent pending. It's been patent pending for a year now. And that's it.
What does it cost to produce a machine like this, Steve?
Well, it could be scaled up or scaled down, but to put one on an average air conditioner would be maybe $1,000, and it would recoup the money, recoup that $1,000 in savings on your electric bill in about 2 years.
So are you talking about this being a consumer product? It's people who buy these products for their homes and take it from there?
Well, I see it in the beginning as more of an application for large industrial uses, but like anything else, it'll miniaturize. And yes, I do see it in homes. I also see it to be used in automobiles and buses and trucks, because if you remember on one of those slides, it works with low air pressure and high air volume, like a car running down the highway. So that'll take years.
So you're going to need to decide on what is the market entry. You can't do all of those things at once. You're going to have to decide where you want to enter the market with what product. Now, if that decision leads you to doing a consumer product at $1,000 kind of price point, my recommendation to you would be to go the route of crowdfunding, because these are the kinds of things that do very well in the crowdfunding mode. So you need to learn all about crowdfunding, Kickstarter, Indiegogo, one of those you could use to go about creating a first set of units, maybe 100 units, and you need to get 100 customers through crowdfunding who would advance order the machine, and you need to figure out what you would want to do for manufacturing so that you can fulfill those orders, so that you get some, validation building up. And then you're going to need to navigate a set of clean tech VCs, investors who are willing to fund you to go to the next stage. That is your most likely path forward.
Right. I've looked into that, and that's one way to go. You're correct. Mm-hmm.
So that's pretty much my feedback. I don't really have much more feedback than that at this point of where you are.
I realize it's a little different. It's not, it seems like the big thing now is all technology and, internet.
No, it's not a question of big thing now or other. We are a community and an accelerator for information technology and information technology enabled services companies. We don't really do energy or biotech or clean tech and any of these. So this is not exactly the place for you to get the maximum help. I don't think it would be a great place for you to, seek acceleration services. You need to find a clean tech accelerator that would be a much better fit for you if that's something you're looking for.
Right. Well, I appreciate the opportunity. And I learned a lot from Bruce. That was very good.
Yes, indeed.
So,
that was an excellent presentation.
Thank you, and I really do appreciate it.
You're very welcome. Okay, folks, if you like what we're doing here in 1 Million by 1 Million, please bring 10 serious entrepreneurs into 1M by 1M. And very much what you heard with Bruce, we try to follow methodology and, like a blueprint, so to speak, as opposed to trying to shoot from the hip. I think we're at a point in the history of building technology ventures at this point where we don't need to shoot from the hip. There's a lot of data, there's a lot of history of how companies are being built, how companies have been built, and we can pretty much learn from those and implement those strategies and policies into our each of our ventures roadmap and become a lot more successful. That is the premise on which the entire 1 Million by 1 Million program is built. And I do think the reason I invited Bruce Cleveland to the show is that I think they're doing very interesting work to do the same kind of codification as much as possible, and that's a great initiative. Now, I'll tell you a little bit about how to use 1 Million by 1 Million, and then you can take it, you can decide how you want to use the accelerator. everything resource-wise is at 1Mby1M.com. There's a terrific blog series where you find everything for free, but a tremendous amount of case studies, trend information, methodology information, etc. The Entrepreneur Journeys book series is 12 volumes of case study-based books where you will find 12 to 16 case studies each. Same principle as we discussed earlier is learning from people who have done it before and what have they learned, what have they gathered methodology-wise. And then you have these roundtables, these free roundtables. Now, we have so far done every Thursday. From February, it's going to be mostly Thursdays. We are going to switch one of the third Thursday, we're going to switch to Wednesday. So, Maureen, you may want to adjust this slide for the future. And the full acceleration program from 1 million by 1 million is the 1M Premium, and that's a $1,000 annual membership fee for extensive methodology guidance, a full curriculum, help with business development, strategy consulting, and help with financing and media relations. So that is our premium program. Go to the 1M self-assessment and ask these questions of your company and your strategy and see how much of this you can answer satisfactorily. And that will decide where you are in your, whether it's fundability or achieving all these milestones of repeatability and traction and so forth. If you get stuck on methodology points, go to 1M Basic. And that's the curriculum-only option from 1M, and you can start learning using that and start plugging your methodology gaps as well. So go dig around on the website. There's tons of information on the programs, FAQs, video FAQs, all sorts of things, information about the curriculum. The curriculum is taught in case studies. As I said, 800+ case studies and video lectures. The case studies include 50+ unicorn and entrepreneurs, 400+ venture-funded companies, 300+ bootstrap success stories, and you learn from all of these entrepreneurs and learn how to put one foot before the other in your respective category of business. Our methodology is lean, capital-efficient, bootstrap startups. And you have to pretty much bootstrap first, raise money later. And as you saw, it gets harder and harder to get attention from VCs because they're looking for a lot of the risk factors, the MVP, the MVR, minimum viable, repeatability, all these risk factors taken out as early as possible. So you're going to need to, understand how to bootstrap your way as much as possible or do it in a very lean, capital-efficient manner to get to more of these milestones that take risk factors out to qualify to raise more financing. So that's pretty much it. So upcoming free roundtables are every Thursday until the end of February, except the February 14th one is a Wednesday. You can register online. So we also have in-person rendezvous, and we have 2 more left in January, next Wednesday, and the Wednesday after that. We had one last night. That was lovely. And you have a chance to come to Cafe Boroni in Menlo Park, and I will be available from 5 to 6 p.m. to meet with you in person and chat about your businesses and so forth. We'll have a chance to get acquainted. So that's it. We have about 12 minutes left in the program where you can ask questions, do any kind of, we can have any kind of discussion that you would like to have. If you want to raise a topic that you want discussed, please go ahead. You can either call in or use the public chat to ask your questions or comments. You can also introduce yourselves. Who are you? Where are you coming from? What brings you here? What are you working on? What challenges are you facing? All of that is welcome at this point. I see a couple of comments in the public chat. Ashok Shanmugam is asking how Traction Gap, it's not Track Gap, it's Traction Gap Institute different from other incubators. Most incubators operate in the, pre-MVP to pre-customer stage. We are doing more than that. We're doing 0 to 1 million in revenue and even beyond in some cases. There are incubators, there are accelerators who are looking to go from, they're actually, because some of these accelerators, most of them take equity, and they're looking to invest in companies that already show some degree of validation. So they are trying to get to that phase where there isn't traction yet, but there is at least some degree of validation. So in a sense, the Traction Gap Institute is also, it's not an, by the way, Traction Gap Institute is not an incubator. It's more of a think tank, you could say, but the real value is Wildcat Ventures is doing the investments out of companies that they are meeting through the Traction Gap Institute. So it is kind of like a nonprofit arm of the Wildcat Ventures venture fund that Bruce represents. Dr. Muid Quinn says it was his first session. It was great. You're very welcome. Anybody else? Any other questions? While you're thinking about your questions, here's Irina Patterson. You can contact her anytime, Irina at 1Mby1M.com, to ask more questions about the program. Anybody, folks? Questions, comments? Anybody? Questions, comments? Joyce Shanahan, how much energy and effort to put into long-term traction plans when at the beginning? Well, you have to kind of put one foot before the other. You have to figure out how you're going to get to the next milestone and to the next milestone and so forth. So, but you do need to figure out whether you have the ingredients of a significant TAM. I think the TAM analysis is something that you should do early on and figure out how to validate that TAM to see what are your options. If you're working with a $50 million TAM, venture financing is not your option. You're going to have to bootstrap, and in that case, you're going to need a different strategy than the kind of strategy that Bruce Cleveland just presented. That is not the strategy for a company that has to basically inherently bootstrap. And also, if you are building a bootstrap business, you don't need to follow these timelines either. You can do it at a linear scale, and you can go from 0 to 1 million in 3 years, and then 1 million to 5 million in another 4 years, and that's all fine. Joyce is asking, I'm working with an engineer who wants all numbers to be correct and perfect, when in my experience, you need to guesstimate, focus on prototype, not worldwide. You do need to estimate. Any good strategy requires a certain amount of analysis and estimation. And Joyce, as you go through the 1M1M curriculum, you will see that we also are proponents of doing planning ahead of time and understanding where you're going, what you're going to, what is your business model, what is your pricing model, what is the velocity of building this business, what is the TAM, all this stuff needs to be assessed and estimated. And not build any prototype until you've got a sense of what is the business that you're building, and are there people who are willing to buy your product. So go through the validation module and you'll learn all that. Anybody else? Any other questions, comments? No? All right. Well, then we will meet you next week, and we'll continue working together. Remember, this is a working session, so bring your businesses. We'll work together and strategize. Thanks for coming today. I hope you enjoyed the session. Bye.